All right, let's continue our discussion. Okay, so where we are trying to understand how bank can create money, right? So we just learned the business model of bank. So basically, the bank attract deposit from savers, and then so the bank will lend out those money, make loans, and make profit. And I just explained to you, the bank typically set aside a fraction of the deposit to avoid some potential issues in the banking system. So we will get that in a little bit of details later. All right. Okay. So now we understand that. So now we probably should be ready to understand how the bank to generate money. Okay. So this T account, right, and the bank reserve, this is a currency that the bank holds in their vault for their deposit at the Federal Reserve Bank to avoid some financial problems. And so another term is called reserve ratio, which is a fraction of bank deposit that a bank holds as a reserve. In this case, they have a deposit of 1 million and they have a reserve of 100,000. And then the reserve ratio is 10%, right? Okay. So this just summarize what we have learned so far. The primary purpose of financial market and institutions is to act as a bridge between lender and the borrowers. But of course, so the bridge is not free, right? So you must pay for the bridge. Okay? So they are not non-profit. They are not a charity, right? So they provide this service between lenders and the borrowers, and then they must charge a fee, and this fee is to support their business model, right? But throughout this process, by accepting deposit and making loans, banks and other financial institutions, they are able to create money, right? So that's the focus we will discuss, right? All right, so in the following few slides, we will look at what the issues there may emerge during this process of creating money, and how the central bank or the government has designed some policies to avoid such problems. Okay, so I'm going to skip this part. But we will come back later. But first, let me explain to you how the bank can generate money. So once we understand how bank generate money in reality, and then we can understand what are the potential issues, and then further we understand why the government designed those things we just skipped to avoid such issues. Okay, so now let's see how bank creates money. So we start a simple example. So there's a gentleman, Silas. He keeps a shoebox full of cash under his bed. And then, given we are in 21st century, and he decides he's going to deposit this cash at the bank instead of keep underneath his bed. Now, what would happen to money supply? So that's the first thing we need to figure out, right? So let's see. If Silas deposited the cash in the bank, and so what that means, so the currency in circulation is going to decrease by 1,000. But now the checkable deposit is going to increase by 1,000, right? And then the net impact on money supply is 0. The money supply will still be 1,000, but essentially the money supply changed from currency to deposit, right? So there's no impact on money supply. But this is before the bank makes any new loans, right? So basically, So before the bank make any new loans, so the money supply change from cash into checkable deposit. Okay, and then so before make any new loans, so the bank essentially just put this 1,000 into their vault, or they just put this 1,000 in central bank's account, right? But in any case, so the money supply stay at $1,000. But based on what we discussed in previous slides, the bank, they are business. Like I said, they won't sit on this deposit by doing nothing. So that is going to make them lose profit. Okay, and then what they're going to do, so they start to make loans. All right, so now if they make loans, what will happen? Now let's look at right hand side. Okay, so they are going to make some loans, right? But the loan they can make usually is less than the deposit they have, just due to the potential problem I mentioned earlier, but I need to explain to you in details a little bit later. All right, and so given a 10% reserve ratio that we just looked at in the previous example, so that just means the bank can make $900 of loan, right? So now this $900 of loan becomes the bank's assets. But you may ask yourself, where does this loan goes? Right? So actually, so this loan will go to a second person. So in this example, let's say go to Maya. Right? And so Maya, so now has 900 loans. What Maya can do? There are two options. Number one, open an account in the same bank, and then the bank is going to write a certificate says Maya has $900 in the checking account, but at the same time Maya is on the bank of $900. Right? So then balance each other for Maya, because Maya has 900 saving, and at the same time Maya has 900 loans. Because actually Maya walks into this story with zero money. They just Maya just take a loan from the bank. The first option Maya has is, so I'm going to open a new account, and then so I have $900 in my account, but at the same time I own the bank of 900, break even. All right? Okay, this the second option Maya has is withdraw this $900 to do whatever Maya needs to do. Now, in either case, what is going to be the money supply? Okay. So now the money supply is going to increase by 900. Why is that? It's because now Maya has $900. It can be in checking account. It can also show up as cash. But where does Maya's $900 coming from? Coming from the loan the bank just made. But how come the bank can make a loan? It's because the bank has original deposit from Silence, right? And so here, so this table just shows us the process. In the first stage, Silas keep his cash under his bed. Currency in circulation is 1,000. No bank deposit. Total money supply is 1,000. Now, In second case, Silas deposited cash in the bank. Bank lent 900 to Maya. Maya withdraw the cash, use the cash to pay Anne. So now Silas, he still has 1,000 in the bank. Maya withdraw 900 from the bank and pay this 900 to Anne. Okay? But this cash in Anne's hand is considered as money supply. Now you can see, so the money supply increased to 1,900. Now this process will keep going. And so she is going to deposit $900 received from Maya. Okay? And then, so the deposit will increase by 900 compared to here. So this includes Silas and Anne's money. And then the bank will lend out a fraction of this 900 to another borrowers, say Joe. And then the Joe is going to do the same things as Maya did. And then so on and so forth. You can see this process is going to play out indefinitely. Right? So from here you can see this is how the banking system can generate money. And from here, you probably see something familiar as we discussed earlier. There's going to be a multiplier. What's a multiplier? So this is the original money we have compared to the total money supply we will have towards the end of this process. This multiplier is going to largely rely on the reserve ratio. Why is that? It's because if the reserve ratio is close to 0, and then so the bank can lend out something close to 1,000. And this process keep going, so you just keep adding 1,000 permanently. On the other hand, if this reserve ratio close to 1, and then so the bank basically can lend out something close to 0, and then the total money supply is going to be 1,000 plus a bunch of number close to 0, right? So that just helps you to understand the size of the multiplier and its relationship with reserve ratio. So next slide, just summarize what we have discussed. Right. So first, excess reserve. That's the bank's reserve over and above its required reserve. Right. So what that means, in the previous examples, the bank is required to set aside 10% of the deposit to avoid the potential problem the financial system will face. Right? So, and what is excessive reserve? It just means the bank may leave aside 20%. But in normal time, nobody won't do that because this additional 10% reserve they set aside will bring them very little profit. Bank is like a regular business, so they behave on their best interest. They will do their best to make additional penny out of the resource they have. So they will make loans, right? So that just means excess reserve usually won't exist. Now, the other things we just discussed is, so what is going to be the net impact on money supply if there's an increase in bank deposit, right? So example here, 1,000. And then, so essentially we just add up the money supply we generate throughout the process, as we discussed. So this is initial deposit. This is the first loan they make. Right? RR is a reserve ratio. This is the second loan, maybe the second bank make, and so on and so forth. We add them together, we get something familiar. Right? So 1,000 divided by RR. Or in other words, the multiplier is 1 over RR. So this RR is similar to marginal propensity to save, as we discussed in previous chapter, right? So in that sense, so this multiplier is very much like the multiplier we discussed in previous chapter. Okay, let's just look at 2 practice questions before we go back to the previous slides we just skipped. Okay. So given the T account, assuming the bank holds no excess reserve, what is the required reserve ratio? So deposit of 1,000. Required reserve is 100. So that's clear, right? See, the answer is 10%. And by the way, here, this example just shows you what type of assets the bank is going to hold. So they make loans. They also invest in treasury bills. So that is essentially make a loan or lend to the government, right? Other practice questions. Suppose the required reserve ratio initially is 10% and is increased by the Fed to 20%. Holding everything else constant, this will A, reduce the size of money multiplier. This is not correct, right? So the money multiplier equal to 1 over RR. RR increase, that's going to reduce the multiplier. B, cause the banking system to contract the level of bank deposit in the banking system. Yes, this is going to reduce the money supply through this multiplier effect. And the C, change the value of money multiplier. Wait. Apologize. So the first one is correct. Reduce the size of money multiplier, because I saw this increase. Yes, it reduced. And the B is also correct. C, change the value of money multiplier from 10 to 5. So that's correct, because 1 over 0.1 to 1 over 0.2. So that is 10, that is 5, right? From 10 to 5. So answer is D. Answer A, B, and C, they are all correct. Now let's back to the slides we just skipped. So now we understand how bank generates money, right? Okay. Now, so throughout these money generating systems, that is going to create some potential risk, right? So what is the potential risk? Because the bank attract deposit, but then so they make loans, and typically loans like a longer term than your deposit. You may need your deposit anytime. But what happens? So there is a gap between the loan maturity and the deposit demand. And then, so the system becomes fragile. So essentially just means, okay, so you go to your local bank, you want to withdraw cash, but unfortunately, all the money the bank has went to some local business as loans. That makes you nervous. And if you are nervous, and then so you're going to take you're going to tell a friend, and or you're going to tell your family, right? So you tell them to go to the bank to withdraw your cash, because you don't know what happens, because the bank or the tailors seems like has hard time to give you the cash. If everyone nervous and everyone went to the bank, and then the bank is going to run into big trouble. This is what we call the bank run, right? Okay, so the bank run is caused by the fundamental business model of bank, right? Because the bank essentially attract deposit and lend out. Okay, and then to avoid such problems, the central bank or the government requires a few things, right? So, but ultimately, if the bank doesn't allow to make any or the reserve ratio close to 1, if that's the case, and then there will be no problem, right? Because all the money is in the bank's vault, and so anytime you can get your cash or your checkbook deposit. But certainly, so the bank will broke because they won't make any profit. So reserve ratio must be less than 1. But if reserve ratio goes to 0, and then there's tremendous amount of risk, because anytime you walk to the bank has no cash. Right? And from this discussion, you may have a sense how the central bank will regulate the financial market, and particularly the bank, to avoid the potential problem I just explained to you, right? So over time, the central bank or most modern economy, so they have designed 4 different mechanisms to avoid such things to happen. Right? So this thing is called bank run. By the way, bank run is formally defined as a phenomenon in which many of a bank's depositors trying to withdraw their fund because they fears a bank failures. A bank failure essentially, it just says they cannot withdraw their money, or there's no money for them to withdraw. Right? So there are 4 things. All right. So those are the historical experience. Now here there are 4 bank regulations. First one is called deposit insurance. So this is insurance each legal bank must purchase in the United States. If you want to operate a bank, you must purchase this deposit insurance. And this insurance is organized by Federal Deposit Insurance Corporation, or FDIC. Okay? And so what this FDIC is going to do is, so essentially every bank, commercial bank or retail bank, for any deposit they attract, they must buy insurance, right? And this insurance is going to guarantee in case this bank fails, the depositors, they has the privilege or have the right to get a compensation at least up to 250,000, but certainly depending on how much you deposit, right? So if you deposit 500, and then so if the bank you put your money in went broke, and then so you are guaranteed to get 500 back from FDIC. If you have 500,000 deposit, and then so if the bank you put your money went broke, and then so you can go to FDIC, there's a guarantee you will recover at least 250,000, but above that it's probably underwater, right? So this is to protect depositors, right? So this is the first regulation so we have seen in reality. Okay, so there are other 3 regulations. So I would rather stop here for today, and so we will continue our discussion on Wednesday. And thank you so much for your attention.